All right, let's just jump right in. Welcome to this explainer where we're going to practically break down the invisible timeline of wealth creation and really show you exactly how to make your money work significantly harder than you do. We're going to dive deep into the specific mathematical pressure points that take a completely modest monthly deposit and turn it into an unstoppable financial machine. So get ready, grab a coffee, because the way you view your bank account is about to fundamentally change for good.
Okay, let's start by tackling a really incredibly common frustration. If you've ever started investing, diligently putting away maybe $100 a month, only to check your balance a year later and feel this dull, aching frustration that absolutely nothing is happening, look, you are not alone. You're actually experiencing a psychological trap that behavioral economists call the feedback gap. See, as humans, we're hardwired to continue behaviors that produce visible, immediate results. But in the early years of wealth building, compounding generates returns that are so microscopic they just fall completely below our perceptual threshold. Your brain is literally screaming at you that it's not working, but the reality? It's working exactly as designed. It's just happening at a scale that's too small for you to feel yet.
And I think this perfectly illustrates the exact difference between simply saving and truly investing. Saving your money is kind of like safely storing a handful of seeds in a glass jar on a shelf. Sure, you're protecting them, and yes, for sure, they aren't going to disappear, but absolutely nothing is ever going to grow in there. Investing, on the flip side, is taking those exact same seeds and burying them in the dirt. It's messy, it's highly volatile. Sometimes a storm rolls through, the market drops, and it seriously feels like you are losing ground. But if you zoom out over the long term, that soil is literally the only place a harvest can actually grow.
So let's talk about a concept called the phase transition. I want you to think of your investment portfolio like a car engine that's equipped with a turbocharger. Now, a turbocharger works by using the engine's exhaust gases, basically the waste energy, to spin a turbine and force more power back into the engine itself. But here is the secret the mechanics know. Turbos do absolutely nothing at low RPMs. Below a certain speed, there just isn't enough exhaust pressure to spin that turbine. Right now, in the very early days of your portfolio, your manual monthly deposits are the only thing powering the engine. You're just pedaling. But eventually, the exhaust pressure of your compounding returns will reach that magical RPM threshold to engage the turbo, and the math will completely take over.
Let's actually look at the hard numbers to see this in action. Say you're only investing $50 a month. Look at that 30-year mark on the table. You end up with $74,500. At that specific contribution level, your portfolio literally never reaches the RPM needed for the turbo to kick in. You are stuck manually pedaling this financial bicycle for 3 entire decades, only to end up with a terminal balance that couldn't even cover 2 years of average living expenses. But notice what happens when you bump that input up to $400 a month. Boom, you cross $500,000. The time frame is exactly the same, the interest rate is exactly the same. The single solitary variable that changed is the fuel you're putting into the engine.
And that brings us to this absolutely crucial point. When people feel that frustrating feedback gap early on, they almost always incorrectly diagnose the problem. They think to themselves, well, my return rate is just too low. So they start chasing these highly risky double-digit returns on sketchy individual stocks or crypto, just trying to speed the whole thing up. But the data tells a completely different story. Chasing returns usually leads to panic selling during market dips, which mathematically just destroys your wealth. The absolute most expensive mistake early investors make is trying to optimize their return rate, when mathematically the absolute smartest move you can make is simply increasing your monthly deposit.
By simply finding an extra $250 a month, which, by the way, is statistically less than half of what an average American pays for their car every month, you can hit that phase transition years earlier. And crossing that threshold just a few years earlier, that gives the magic of Phase 2 compounding the runway it absolutely needs to add nearly $200,000 of extra wealth to your terminal balance. Think about that. You aren't doing anything riskier. You are literally just providing more fuel up front.
Now, before we get into the exact practical behavioral systems that you can use to find that extra monthly fuel completely painlessly, take a second to reflect on how this shifts the way you view your own portfolio. And hey, if this explainer is changing how you view your investments, make sure to subscribe to Langford Invests.
So the million-dollar question, how do we actually find this extra money? Well, first off, relying on willpower is a terrible, terrible financial strategy. We all suffer from something called hedonic adaptation. It's this psychological phenomenon, basically lifestyle inflation, where every single time you get a raise or pay off a debt,
your expenses quietly and automatically expand to absorb that newly freed cash. Within a few months, that new car just feels normal, the nicer apartment feels normal, and poof, the money is just gone. To actually win this game, we have to build a system that literally outsmarts our own brains.
And this brings us to the two-account system. It's incredibly simple, but highly effective. You separate your direct deposit into a bills account, and here's the kicker. You never, ever carry a debit card for this account, and a smaller, separate spending account. By moving your excess money completely out of your visual field, you eliminate frictionless spending. It's exactly like taking a bowl of candy off your desk and hiding it in another room. Out of sight, out of mind. By automating your investments and your fixed bills first, accidental overspending becomes mechanically impossible. You really don't need ironclad discipline, you just need better architecture.
Once your new automated system finally gets your portfolio to that $100,000 threshold, I'm telling you, the entire game changes. The turbocharger finally engages. At this level, a totally conservative 8% return starts handing you $8,000 a year for doing absolutely nothing. Just really think about that for a second. Your money is now generating over $650 every single month in pure invisible income.
And this brings us to a massive, massive turning point. It's the exact moment you transition from being a saver to a capital owner. In the beginning, as you can see, your growth is tiny compared to your manual deposits. But once that turbo kicks in, the entire split flips. The market growth overtakes your deposits. Your money is now literally hustling harder on the graveyard shift than you do at your day job. You are no longer providing the majority of the power. The engine is feeding itself.
As a capital owner, your psychology completely flips. When you only have $2,000 invested, a market drop feels like a devastating setback. But when you have significant capital behind you, a 10% market crash suddenly stops causing panic and starts looking like a fire sale shopping trip. Your lifestyle becomes securely locked in by the sheer mass of your portfolio, so you actually stop worrying about the daily noise of the market. Instead, you start focusing on protecting those assets and aggressively taking advantage of the discounts that volatility provides.
Then, right around the $300,000 mark, the math starts to bend upward so steeply that compounding stops feeling like a slow crawl and starts feeling like an unstoppable freight train. You have officially passed the threshold where your own physical labor was the primary driver of your wealth. Now, the sheer momentum of your past decisions is carrying you forward at a speed you could quite literally never achieve through manual saving alone.
Just look at the compression of time here on this timeline. If you're on a path of investing $500 a month, it takes roughly 8 agonizing years of extreme patience to reach your first $100K. But then, it only takes 5 more years to double that to $200,000. And by year 22, you're sitting on $600,000. It's pure proof that early patience pays out exponentially. The hardest part of this entire journey isn't reaching the wealth. The absolute hardest part is simply protecting it long enough for the avalanche to take over.
But here is the ultimate secret that most people don't know, and honestly, the financial media rarely ever talks about. Because, let's face it, it's just not flashy enough. $500,000 is very often enough to completely escape the rat race as long as you structure it correctly. You absolutely do not need $5 or $10 million to buy back your time.
Let's actually break down the mechanics of this, what we'll call the 500K freedom engine. If you park $500,000 in a highly safe 5% fixed income setup, it just hands you $25,000 a year. But if you put it in balanced index funds, returning a fairly conservative 8.5%, it spits out $42,500 a year. Guys, that is over $3,500 every single month, easily covering your baseline freedom without you ever needing to clock in again. And crucially, you were doing this without ever touching the principal $500,000.
Which highlights the really fundamental difference between two entirely different ways of thinking. The consumer brain incorrectly assumes that retirement is basically like slowly draining a bathtub full of cash, just crossing your fingers and hoping you die before the water completely runs out. But the investor brain? The investor builds a machine that outlasts them. You deploy your capital specifically so it births more capital, and you only live off the exhaust. You basically achieve a kind of financial immortality, where the machine just runs on its own.
Ultimately, the true reward of investing isn't the private jets, the designer clothes, or showing off on social media. It's none of that. It's the absolute power to wake up on a random Tuesday morning without an alarm clock screaming at you. It is the power to say no to a toxic boss, or to just walk away from literally any situation that drains your energy. True wealth is the ultimate tool for reclaiming your time and your personal autonomy.
the next 10 years of your life are going to pass anyway. Whether you invest or not, that time is already spent. So you really have to ask yourself, are you going to keep trading your future freedom for quick, cheap dopamine hits today? Or will you use the mechanics we've just discussed to start building your pile of options? The turbocharger is right there waiting for you. You just have to supply the fuel.
Thanks for watching. If this gave you a new way to think about your wealth, subscribe to Langford Invests. Leave a comment below with the one savings move you're making this year, and I'll see you in the next one.